Alright, welcome to this new spring enrollment video where we will go over the basics and why after 2 weeks of content now all of a sudden we are going to go over the basics. The reason for that is because the basics for us are already extremely advanced. So the things that we went over thus far in week 1 and week 2, we needed to go over that before we could actually understand the basics fully, before we can make it easier to understand as well. Now, before we dive into the concepts, I want to also explain right here the foundation levels, that the concepts we are going to go over in this video and throughout this week as well, they apply to basically every single foundational level. Now, of course, we are still at number 2 at narrative, right? So this helps with the bias and the narrative, but this will eventually also help with your entry, with your risk management. It helps with everything. And that's with every concept that we have gone over thus far. It helps with every foundation level. It just depends where do you want to use that concept. Because for example, market structure, which we're also going to go over, if you apply that in a bias on a monthly time frame, then you might be a different type of trader. So that is depending on where you want to use it. Where again, we currently are still at narrative. So before we dive into the boundary and the target, it is extremely beneficial to understand the concepts that we are going to go over. So what then is those concepts and what are the basics essentially? The basics is understanding how the market moves, how the market operates. The first thing right there that we see is offering fair value. The second thing is seeking liquidity. This indicates that the market is always doing one of those two things. It's either offering fair value or it is seeking liquidity. There's not a hierarchy. One is not necessarily better than the other. We just need to understand that the market is always either seeking liquidity or offering fair value. And if it's not doing the other one, then it's doing the other one. So if it's not offering fair value, then it's seeking liquidity. If it's not seeking liquidity, then it's offering fair value. So what does that look like? Well, then we need to understand what then is that offering fair value. Offering fair value, and it's already in the name as well, fair value areas. So the fair value areas is where we offer fair value. So what does that mean? Well, what are those fair value areas again? We have a mitigation block, an order block, and a breaker block. Those are the fair value areas that we use. So the mitigation block that we see right here is a fair value area. Then a bullish example would be of a fair value area, a buy side, sell side, and buy side. Bearish example, sell side, buy side, sell side. Now what that looks like, I'm going to show you in just a few moments in the chart as well. Then we have the order block, same as the mitigation block. An order block, essentially, and this is quite a funny thing, an order block is the exact same thing as a mitigation block. It's just viewed from a different time frame as well. What that looks like is I'm also going to show you in a little bit. Now, here we have the last one, and that is the breaker block. A breaker block essentially is a filled order block or mitigation block, which also creates that fair value area where we can now offer fair value. So what does this mean and what does this look like? Whenever we offer fair value and whenever we create fair value areas, I like to refer to the 3 swing movement. So for a mitigation block and an order block, it's the exact same thing. It's just dependent on how the candles actually form. Now, right here, if we look at a mitigation block and an order block, we have one movement higher. So this is the bullish example where I mentioned buy side, sell side, and then buy side again. So what does that mean? We have a move higher. Here we are offering buy side to the market. So we offer buyers a fair chance to get involved. Now, after we move higher like this, we can also see we have only offered buy side. So what does that mean? Well, sellers, did they get a fair chance to get involved? No. So what does that mean? We need to offer fair value. Because if we don't offer that fair value just yet right there, and that is seen by only having that buy side move, only having one movement higher on one side of the market, then we can still expect a retracement where we will now offer that fair value sitting right there. And then we can eventually continue higher. So we have buy side, we have sell side. Why do we offer sell side again? Because we're offering that fair value right there. We're offering fair value before we actually continue higher again right there. That creates a fair value area right there because the down movement that we see when we offer that sell side, so we offer a fair chance for both buyers and sellers to get involved, creates a mitigation block or an order block right there, which we see by this fair value area. So why is this now a fair value area? Because that is where we have offered fair value right now. So price is not allowed to move higher in this instance as well if we have not offered fair value just yet. So as soon as we move back above this high right there, we create a fair value area in the form of that gray box, in the form of the down movement, the sell side movement that we had sitting right there. That is the fair value area. So if we understand that that's the fair value area, then where can we now retrace towards? Well, that is this area right here, above the fair value area, because this is the only area, the gray box right now, where we have not offered fair value just yet, because that is where we only have buy side. Again, one leg higher right there, only buy side, no sell side, no three swing movement right there. So if we want to retrace and we now want to offer fair value again, then we will offer fair value right there at the top of that gray box. So we can continue higher off of that right there, because now we're offering fair value. Anything below that or deeply below that, this right here is not offering fair value. Why? Because there is no fair value to offer anymore right there. The only fair value that we can offer is again at the top, this gray box, because that is the fair value that we have not offered yet. There's only buy side, there's only an up move that we see right there. So the retracement can be towards the high right there of the mitigation block or the order block as well. So what does this actually look like in the chart? Well, if we take a look at crude oil right here, then we see the following. We have a move higher like this, movement higher like that. We have a move lower, so sell side. We have buy side, we offer sell side, then we offer buy side again right there. So the only place at this moment in time where we have not offered fair value just yet is above the high right there, above the mitigation block high. So this right here, how far can we retrace? Towards the mitigation block high right there before we actually continue higher right there. So that is the fair value area. We are offering fair value right there to then continue higher off of that. Now this of course is also fractal, because if we now take a look at this example right here, then we see an order block actually and not a mitigation block in the form of this one right there. This order block, and the reason I mentioned order blocks and mitigation blocks, essentially the same thing, just looked at it from a different time frame, so from a different perspective, because this order block, if we zoom in on that order block, eventually it will become right here on the 1 hour already a mitigation block. So what is the difference again really quick between that order block and that mitigation block? An order block has only consecutive down candles. So for example, the bullish order block right here would be this right there, because that is the consecutive 2 down candles. With a mitigation block, we can have up candles, we can have down candles. It's just the whole move lower right there. The order block is only the down candles lower right there before we continue higher. So that is the difference between order block, mitigation block, which usually leads to the same thing, just an overall fair value area. So here we again see the same thing, right? Where this is again the fair value area that we can now continue higher off of. So if we want to retrace, we can retrace towards the highs right there to then continue higher, because that is where we have not offered fair value just yet. Now, the breaker block is a little bit different, because the breaker block looks something like the following. This right here, what I'm going to show you, is a bullish breaker block. So we have a move higher, again, the 1. Then the second move lower right there actually takes out a low right there. That's the second move, that's the sell side. And then we have the buy side again right there. This again creates a 3 swing movement, but it's a little bit different in form of the mitigation block would have been like this. The low would have been lower right there. Same for the order block. But the breaker block actually takes out this low right there before it makes the move higher. So we have buy side, we have sell side, and buy side again right there. Where here we have now offered fair value right there to the market. So if we want to continue higher, then it becomes the same story. It's just how we identify those fair value areas. That's a little bit different. But it's the same story. where the only place where we have not offered fair value yet. So fair value again, where buy side and sell side is overlapping. That is where we offer fair value. It's always the most recent 3 swing movements. So of course, will we have arguments? Well, isn't then the whole market already fair value because we have made so many swing movements right there? Yes, correct. But it's always the most recent 3 swing movements. How we can identify that a little bit better as well. Exactly all things we are going to go over. Now, right here, the only place where we have not offered fair value, so where buy side and sell side is not overlapping, that is above this high right there. Because that is where we only have buy side, where we have no sell side. So let's say if we now were to retrace, then how far can we retrace? Well, we can retrace towards the fair value area high right there. Because this is where we have not offered fair value yet, and we can now continue higher. So if we are offering fair value, then we can only offer fair value until that high, because the rest below that is already fair value. So the bigger the retracement right there and the deeper the retracement into this fair value area, then we could make the argument, well, why are we sitting right there? We're not offering fair value. So why do we have such a big retracement when the fair value area and where we can offer fair value is sitting at the highs right there? Now, if we take this example and we look at the chart as well, then we stay on crude oil right here and we take a look at this example right here. We see that we now have, again, that 3 swing movement. So I'm going to use the gray boxes. We have 1 right there. Then we have number 2 right there, the sell side with that down candle. And then we have number 3 with that movement right there. So we can see this movement lower takes out that swing low. So that makes it different from the mitigation block and the order block right there, because it takes out that low right there. But it's the same exact premise. We have a 3 swing movement. We have 1, 2, 3 right there, which leaves behind that area right there, which we can continue higher off of, because that is now the fair value area. So the high that we take right there, that is the fair value area, and that is how far we can actually retrace. Any retracements below that into this fair value gap, for example, is quite suspicious, because we don't have to retrace that far, because that is the fair value area, and that is where we will offer fair value as well. All right, so we have a brief understanding of offering fair value and why we use it and why that is important to understand as well. Now, next to that, of course, the next part is seeking liquidity, because we are either offering fair value or we are seeking liquidity. So if we are, again, like we mentioned, not offering that fair value, then what are we doing? Well, first step, we are not offering fair value. Okay, so then we are seeking opposing liquidity instead. So what does this look like? So here we are on Euro US dollar. I'm going to again draw the schematic one more time right there for the mitigation block and the order block. Essentially, again, the same thing for the breaker block as well. So what that looks like is we have that 3 swing movement. The buy side, the sell side, and the buy side right there. Creates again that fair value area that we see right here. Where if we now want to offer fair value, then the retracement should only be towards that area to then continue higher. Because below that, the gray box is already fair value. So we can't offer fair value twice right there because there is already fair value. So if we now do not respect that and we now start to retrace deep into that fair value area, then what conclusion can we make? Well, that area is already fair value. So why are we retracing very deep into it? Then it's not for offering fair value anymore. So what is then the next part on how the market moves? What's the second part? All right, that is seeking liquidity. So the swing lows that we might have right there in this leg higher right there, that is where we will target, where eventually the target will become the low of that fair value area, which we might also know as the last line of defense. Again, what is that liquidity? That is the last line of defense. That is the swing points. That is the previous candle high, previous candle low. Those are our liquidity. So if we are not offering that fair value, then the low actually becomes the target right there, because then we are seeking liquidity in the form of opposing liquidity, where when we are offering fair value, of course, we are in some way also seeking liquidity, right? Because if we do something like this, we retrace into the fair value area, then we leave behind a swing high at the highs, previous candle high, whatever it may be. So we are still seeking liquidity in the form of the highs right there. So seeking liquidity in this case is indicating that we are seeking opposing liquidity in the form of the swing low right there, the last line of defense actually, where that is exactly what we will then eventually target if we are not offering that fair value. So what does that look like? Well, right here, if we go over Euro US dollar, then we see the following thing. We have a 3 swing movement right here. 1 buy side, 2 sell side, 3 buy side again. So the only place where we have not offered fair value just yet is again this area above that high right there. So right here, this is the fair value area. That is the mitigation block that we see right there. So if we want to continue higher, then what do we see? We should have already continued higher at this moment in time once we come into this fair value area right there with those rejections to then potentially continue higher. Then after, we start to retrace quite deep into that fair value area. Why do we do that? Well, it's not offering fair value anymore because the fair value got offered right there at the beginning once we touch that gray box. So what are we doing instead? We are actually seeking liquidity as soon as we see a deeper retracement into it. So then the low of that fair value area right there actually becomes the target instead. So not expecting higher prices anymore. Just like we mentioned in previous videos, the last line of defense is not something we want to trade off of then. We don't want to keep on pushing our longs and we want to place buys and buys every single time we see it come into any discount array. No, this is how we can refine even more the area where we want to continue higher off of, which is simply seen through the basics. So we mentioned as well in previous videos that the last line of defense then actually becomes a target, which is exactly what we are seeing right there. That is super important to understand. Now, if we of course understand this and we have a brief understanding that this is only the tip of the iceberg, because now we need to know, all right, well, are we actually offering fair value? Are we going to seek that liquidity? How can we then view that? And that is exactly where we now need to incorporate the following two concepts, where we need to go over the difference in PA, and PA stands for price action. So just the chart that you are seeing. Then we have two things. We have again, offering fair value and we have seeking liquidity right there. Offering fair value is oftentimes, and 9 out of 10 times is seen through run on liquidity. So if we will offer the fair value to then continue higher or continue lower, if it's a bearish mitigation block, bearish fair value area, then it will be seen through a run on liquidity. If we are seeking liquidity, oftentimes it will be seen through a sweep of liquidity. So what are the differences and how can we then identify these different two things? Well, let's first go over a run on liquidity. A run on liquidity right here starts with, again, the liquidity, because we need to first take some liquidity. Liquidity is taken, swing point is taken. After that, we have the second part, which is an FVG. An FVG ideally overlapping with the exact swing point that we just took. Then we have number 3. Number 3 is that, of course, creates a fair value area where we have a fair value gap overlapping. We expect that the fair value area that's created will now be respected. Confirm with 2 candle rejection, and I've also written down comfortable right there. Where we need to go over what that actually means, the comfortable. But before we go over that, I also want to go over the sweep of liquidity. Now, right here, let's actually identify what then is that run on liquidity. So the 3 steps again, we have the liquidity right here on crude oil in the form of that swing high right there. Now, when we have that liquidity, the first thing ideally we want to see, that's the ideal thing we want to see, is that we have a fair value gap overlapping with that exact liquidity point that we just took, that we just traded above right there. That now creates this fair value area as well, with that fair value gap overlapping right there with the exact high. Perfect, because that is right now what we can continue higher off of, where we would expect a 2-candle rejection happening right there at that area to continue higher off of that. So this is where we are now offering fair value and where we can expect price to still continue higher because it's a run on liquidity and it's not a sweep of liquidity. So to go over a few more examples, the same thing right here happened on EU, of course, where EU right there, we see the fair value area. We take that liquidity, we have a fair value gap overlapping, we retrace back into that, we expect that to hold. Perfect. So right here, the 2-candle rejection is again important because the 2-candle rejection right here tells us that it is not actually holding. The 2-candle rejection failing at the fair value area is where we can now potentially look to target the lot instead, the last line of defense instead, where we are actually seeking liquidity. So that is how, even though this is looking like a run on liquidity right there, we can now still filter that out because it doesn't have the 2-candle rejection that is holding right there, because that eventually gets taken out at this moment in time as well. And if we follow through with the fair value gaps, then even at this moment in time right there, it gets taken out as well. Potentially even a little bit earlier with that candle right there. And that is how we can know that eventually we might want to continue lower instead. Now, next to that, I see this still sometimes, and I want to address this as well. It's extremely important to understand how you mark out a fair value area. And I believe I've already mentioned it, so I'm going to mention it again right here, that if the fair value area, so if we want to offer fair value and we want to continue higher, then for example, this right here is again a run on liquidity because we have that liquidity point, we have the fair value gap, we expect the respect, we have the 2-candle rejection actually right there. We expect that to continue higher. And as soon as that fails, then perfect. We expect potentially the last line of defense to be traded into. Now, at this moment in time, it's, like I mentioned, extremely important to understand how you mark that out. Because if you do the same as if you are incorporating other PDRAs, that is the exact same thing. If you are not marking out the fair value area correctly, then this will also not work because you're going to be almost very random, because we need to have that accuracy, and that accuracy is achieved through marking out things properly as well. So what I mean by that is if the wick right there is overlapping with the fair value gap, so the highest point of that wick of the liquidity we just took right there is exactly overlapping with a fair value gap right there on the right side. So it's a fair value gap. We can see the expansion phase candle right there is in the middle of that wick right there. Perfect, it's overlapping. That means it's overlapping. If that is the case, you mark out the wick because that part is the sensitive part. That part has not been mitigated just yet. That is the fair value part. So this is important to understand because this means that this right here, this area is not a fair value area. This area above right there is the fair value area. Where if this wick was not overlapping like this, and we did not have an overlapping fair value gap with that exact height we just took, then this is the fair value area right there. Which one is higher probability? I would argue whenever we have a wick overlapping with the exact fair value gap, that is a little bit higher probability as well. But just goes to show that we do not have two fair value areas right there. There's only one fair value area. There's only one mitigation block right there. And that's the top one. That's the open of the mitigation block. This is not the top of a mitigation block right there. That's just a random line on the chart. So, for example, if we look at this breaker right here, then we see, is there a fair value gap exactly overlapping with the high right there just took on the same time frame, of course? No, there's not. So then you can mark out the body right there. And then the body will be the sensitive part because the top wick has already been mitigated. So that is why we see the retracement right there into the body with that candle and not into the wick. So that is important to understand because that is now the fair value area and not the wick right there. That is extremely important to understand. Now we understand the basis of the run on liquidity. I'm going to show you more case studies as well later on. So right here, the comfortable part is also something I want to go over afterwards, after understanding the following, which is the sweep of liquidity. So the sweep of liquidity, essentially the two parts, or the first part stays the same. The second part stays the same as it. It's also a fair value gap, but it's a little bit different. So the first step right there is liquidity. Liquidity is again taken a swing point. Then number 2 is an FVG again. So no FVG overlapping with the swing point. And I wrote down right there, retrace the steps. So whenever we run liquidity or we sweep liquidity, we can retrace the steps towards what actually happened. So we can get the earliest sign that there might be a sweep or that we might run the liquidity. And those early signs is again retracing the steps. Now, after that, we have number 3. And number 3 right there is opposing FVG. We create an opposing FVG targeting opposing liquidity, suffocate the positions. That is how we actually confirm the sweep of liquidity. So what does this then look like? Here we are on the dollar on the 1 hour time frame, and I want to go over this situation right here. We take out this swing point right there. So liquidity is taken right there. Do we have a fair value gap exactly overlapping with that low? No. Okay, that already is a little bit more suspicious. Then the fair value area is actually also a little bit higher because that is not exactly overlapping. So the fair value area is actually this right there. So if we want to continue lower, we should ideally continue lower off of this low right there, the fair value area right there. Otherwise, we are not offering fair value anymore. Now, if we then look at the fair value gap, no fair value gap overlapping. So retracing the steps right there is already a sweep. A potential sweep can be seen as early as not a fair value gap that is overlapping with the exact low that we just took right there. That is already a bit more suspicious because that is usually how sweeps tend to form as well. Then how we confirm that sweep of that liquidity is right now, if we have an opposing fair value gap, which we have right there on the 1 hour time frame, and if we now create new order flow going higher there as well. And now we have order flow confirmed right here after sweeping that low. So that indicates that any premium array, this 4 hour fair value gap that we have, for example, right here, this 4 hour order block right there, has not high probability to hold because we are sweeping a low. So if we are sweeping the low, what then actually becomes a target? The opposing liquidity. So the highs right here, that is what becomes a target. The fair value area high that we have right there, because this is the area that we have already offered fair value in. So we should not retrace back towards that area. So this is eventually where we now continue higher. And when we continue higher, what do we see? Well, we have the same thing. We have 1, 2, 3. This creates, again, a fair value area that is sitting right there. And this fair value area is where we can now continue higher off of. And we can see again the characteristics between the run versus the sweep, the run versus the sweep. That is exactly what we are looking at right there. Where if we have a sweep of liquidity, we are targeting opposing liquidity right there. Where if we have a run of liquidity, for example, right there with this fair value area, we are targeting the next premium array. So we are targeting just higher. We expect the trend to actually continue. So this is where we now can go over as well, comfortable and suffocate. And the difference between suffocating a position and getting comfortable in a position is the following. When we suffocate, that's ideally when we see a sweep of liquidity. So we need to now understand as well a little bit of the market mechanics. Why are we sweeping liquidity? Why are we running liquidity? Whenever we sweep liquidity, right here in the form of that low, we can imagine that there is central banks, there's big institutions that have such a huge orders, that have such magnificent almost the order size, that they cannot get filled just like clicking on buy or sell like we can. Because there's not enough liquidity in the market for them to just get filled. The way I want you to see that is there is a limited pool. There's a limited pool of orders overall in the market. And from the same pool right there, everyone needs to get involved. So we can't just create orders out of thin air. Orders need to actually be filled somehow. So how do orders actually get filled? Well, for every seller, there needs to be a buyer. For every buyer, there needs to be a seller. So if we understand that, what is happening below that low right there? Well, big institutions, big central banks, or the opposite of the market maker, we could call it, where the central banks try to trap people, the big institutions, the uninformed liquidity, we could call it, is the people that usually are trending traders. And that's not your average Joe. That is not us. We are not getting trapped in the market. Believe me, we do not have that amount of liquidity to actually be targeted, to actually be trapped. So that is all nonsense, essentially. Now, the bigger institutions that do get trapped, bigger hedge funds, for example, that do get trapped, they also have significant liquidity. So then it becomes a battle almost between those two liquidity parties. All right, well, if they are selling, if one party is trying to sell right there, then the other party will buy with even bigger orders. So here, what happens below that low? We have breakout traders below that low right there. And breakout traders, they are trending traders, because if that low gets taken, that must be weakness right there. Doesn't matter how it takes the low, but that must be weakness right there to then continue lower. Where that is also used, if we now sweep that low right there, then we can also get in a buy order. So a sell order gets matched with a buy order. So the breakout traders essentially get trapped. Where do they place their stop loss? Above recent swing highs, above, in our case, the fair value area high right there. So why now is a sweep of liquidity then a suffocate? It's something suffocating right there. Their orders of those breakout traders, they need to suffocate. And why do they need to suffocate? Because right here, if we are truly trapping those breakout traders, then we first see a sweep like this, and we should not come back below this low right there, below that entry line. Because that entry line right there is where they can mitigate their orders. They can get out of that entry if they're not too certain anymore, if they are getting somewhat of emotional, they want to get out of that position. We cannot allow that to happen. Why not? Because their stop loss right there is a buyback. So they are buying back at a loss, essentially. Where that is also the central banks, the people that are trapping people, the people that are getting trapped, that are trapping the breakout traders, right there, they have the opposite position. Where their take profit is their stop loss. So they need that stop loss right there to get out of that position again. So we need that opposing liquidity to get out of that position again. So we need to suffocate that position. We need to make sure that those breakout traders right here can't get out of this position. When they are in drawdown, they should stay in drawdown. We can't allow them to come back to their entry level and allow them to mitigate the position. Because if that happens, they are allowed to potentially, and even if it's potentially, close that position right there, then that indicates that we might not have that liquidity right there to actually get out of the position at the central bank's stop to take profit sitting right there. So that is why the stop loss right there, the position of those breakout traders, they need to be suffocated. So let's say the opposite happens. And when the opposite happens, if we have this swing low sitting right there, which is a liquidity point, of course, then we have also this swing high, which we are running right there. We do not have an exact fair value gap overlapping with the high that we just took right there. But what do we see? We are comfortable above that high. What does that mean? Being comfortable above a certain high. Well, right here, let's imagine again the same breakout traders. And the same breakout traders right there are in this position. And when we see that, well, these breakout traders right here, they have a pretty good time, to be honest. They have a pretty good time. And even when we come back below that high right there, we trade back above the high again a couple of times. We have a long wick at the top right there, which we see at the bottom, which comes back above this high right there, which indicates that we do not have the urgency to actually trap and suffocate that position. That then indicates that a run on liquidity right there, we are comfortable above a swing point. And when we are comfortable above the swing point, we are simply trading above it like it's not the end of the world. It's perfect fine conditions. Nothing is happening. We are comfortable above that high, where in the opposite, again, we are not suffocating that position right there. And when we are comfortable above a high, that means that we do not need that breakout liquidity right there. So we can actually just simply continue higher as well. Because if we are suffocating that position, then we should have not been comfortable like that above that high. And that is the difference again between the suffocating and the comfortable, which all leads back to the understanding of how overall we see the market and how it moves with the offering fair value and that sweep of liquidity as well. Now, once we then understand right here the sweep of liquidity as well, the suffocating that position and getting comfortable again below a high or above a high, below a low, sorry. And then we can move on towards the candle signs, the fractal right here of the market, the candle signs. So what does this mean? Number one, we have the 2 candle rejection right there. And number 2, we have the previous candle low, previous candle high closure right there. So what does this mean? This means that everything we have just gone over can be viewed from already a candle signs perspective and can be viewed as well from a fractal perspective. So what does that then again mean? Well, let's look at the chart right here, because both examples where this sweep right there, that swing low, what is that on the higher time frame? Well, that swing low on the higher time frame is a previous candle low. This right here, this running of the liquidity and to continue higher, how can that be viewed again, that we actually want to continue higher right there? Well, that in itself can also be seen through candle signs. So let's look at the daily right here. On the daily, we see this daily fair value gap, which we can continue lower off of. Candle signs right there, already an example that we also went over, supporting the idea that we might want to continue lower right there. We have the rejection, then the second candle is respecting the rejection, continue lower. But it is sweeping the previous candle low right there, which can be seen by that wick at the bottom, which indicates that we have fair value gaps somewhat going higher right there. So that sweep of the previous candle low is a little bit suspicious. Now, why is that important to understand? Because this is how we can potentially already see early signs if we want to sweep or actually run liquidity by just looking at singular candles. So imagine how powerful that will be if you apply this to the 1 minute time frame, if you apply this to the 5 minute time frame. So so further on. So right here on the 4 hour, if we now want to continue lower, then we see the exact same thing. We have this 4 hour value gap right there. And that 4 hour value gap, we see now, what do we see? We have this 2 candle rejection right here. And off of that 2 candle rejection, we see the second candle right there, not closing below this first candle low again. Again, leaving behind that long wick, potentially indicating that that is, again, a sweep of liquidity and not a run on liquidity. Those previous candle lows, previous candle highs, they are swing highs and swing lows on the lower time frame. So we are essentially looking at sweeps and runs on liquidity on the lower time frame already right there by just looking at singular candles. Where the same thing happens right here. That previous candle high right there is getting swept. Why? That long wick. So if we come into a premium ray and we combine that with a premium ray right there, we can understand which side we are sweeping, which side we are potentially running already by looking at those candles right there. And then we can even confirm it by going into the lower time frame eventually. So that is, again, how we can also view this again from a candle signs perspective, which is also quite important to understand, of course. So if we have that 2 candle rejection and we fail to close right there below a previous candle low, or we fail to close above a previous candle high, that can already be seen as a potential sweep as well. So we should be suspicious of that. Now, next thing, and this is going to be the main importance right here. Once we understand all this, we now need to move on to the case studies. And the case studies right here were just recorded just before I actually recorded this video as well. So let's go over them. The first case study that we have right here is on NASDAQ. And I want to show you the first picture right there. So what we see right here is we have one move going higher on the left side right there. Then we have a move going lower right there, offering fair value, and then we move higher again. We have the potential run on liquidity as well. So we see a fair value gap overlapping with the exact high. Perfect. That is the potential run on liquidity to then continue higher off of that. Now, what we see after that is that we struggle a little bit. we struggle a little bit to actually continue higher right here. We are offering fair value and we are not necessarily pushing higher again. So what are we doing right here? Well, let's move on to the next one. We see that we now come back below that low right there. And we are not offering the overall fair value anymore. So the fair value area at the bottom right there actually might become the target right there. So let's see how we want to approach this then. I mentioned if we want to target lower, we should run lows. So we are currently seeing again that we are potentially sweeping that low right there. So until we run that low, we are still somewhat bullish right there because overall we have been continuing higher. It's still in a very early stage. If we do want to continue lower right there, then that should have been seen through actually running those lows. So that right there is important to understand. And then we move on to the next one. We see until then, we are still bullish. So until we actually run this low, we are still somewhat bullish as well, at least more on the 50-50 side. So we still don't want to look at shorts right there. That's the important thing to understand. So right here, we see now we are respecting right there a premium array as well. And we are now running the exact same low. So we come back below it again. We're now getting comfortable below that low. So we are running that low again. So what can we now see? Well, we are not offering fair value anymore. That was already pretty clear. That was already why I started that case study, because it became suspicious. We are not offering fair value anymore. So we might actually want to target the lowest low that we see right there. So now what happens is we can now look to target all those discount arrays, where this essentially becomes the easy part. Because now we are also creating bearish new premium arrays, which are also new fair value areas. And we are running lows, so we can just continue lower off of that as well. So let's look at the next slide. Perfect, we reached that first target right there. Now we have an early signs of a sweep. Nothing confirmed yet, just wait. So right here, we are still running into what we can also see, a fair value area right there. So even after sweeping that potential low right there and a small swing low that we have on the left, on the right side, sorry, right there at where I have my mouse. That right there is where we still need to understand, all right, this is just an early sign of a sweep, nothing confirmed yet. The same thing that we waited for right here. There's nothing confirmed here yet that this might be a potential sweep and that we might target the lows right there. We can simply wait. And I think a lot of people underestimate the amount of time right here you can wait before you take a trade. These are still early entries. The best entries happen later on, actually. So right here, we still wait. And then afterwards, what do we see? We see right here, or we mention 2-candle rejection here at FVA. So if we get a 2-candle rejection right there at the fair value area, perfect. We can still continue lower off of that, even though we have a sweep of that fair value gap. The important thing to understand is that we are in the middle right there of disrespecting this fair value area right there. So we can still actually look to continue lower. So what do we see on the next slide? Offered fair value area, 2-candle rejection to continue lower. So offered the fair value at that area, the 2-candle rejection to continue lower right there. So now the targets again become that swing low. Ideally want to run that swing low again. Then we have the next discount array, next discount array, next discount array, and then ultimately the fair value area low sitting right there. Now what do we see? We see right here, target lower discount arrays. So any discount array that we have sitting right there, that would be the target right there. So here, last resistance before we hit the no re. So where we have no resistance anymore. So where we will likely have fast price action. So the fair value area that we have above that is again this fair value area right now. That line where we can now continue lower off of, where I have my mouse. So right here, what do we see? Should respect the fair value area if we still want to continue lower. So this retracement is nothing to worry about because we are still coming into that fair value area potentially to then continue lower off of that. Now right here, big down candles I mentioned, and the reason I mentioned that is because I was expecting at that moment in time we have no resistance anymore. So this is where price should speed up a little bit. Should happen fast. No resistance, so price can run right there to continue lower. We did not come into the fair value area, but we also did not even incorporate any other PD ray besides the fair value area. Where if we now incorporate fair value gaps, we can see why we stopped at that moment in time as well. So right here, what do we see? We see right here, new fair value area where we are starting to get those big down candles. And afterwards, we have a new fair value area as well, where of course, those big down candles lead to, of course, the target has been reached right there, and they lead to the fair value area getting taken out right there and seeking liquidity instead. So I mentioned, tada, and the cycle repeats. So here the cycle repeats and repeats and repeats again. Where here, what do we see afterwards? We see early signs of a potential sweep. Does that mean that is a confirmed sweep? And that is what I'm trying to get into your mind. Does that mean that's a confirmed sweep? No, not just yet. The same as what we just did at the top right there. We can simply wait for it to show new fair value areas, for it to run highs instead of sweep highs right there. That is what we can wait for to then potentially target the highs again. So that is, again, important to understand. Where if we look at this example in the chart, then we see right here that it's an absolute mess on my chart, but I'm going to leave it right there just to show you again the understanding of what we went through. We see that fair value area, this fair value area, which we struggle to continue higher from. Afterwards, we already had the rejection right there. So once this rejection gets taken out and gets a run on liquidity, that indicates to me that we actually want to continue lower. So here, this is where we can then continue lower from. Eventually, where we target the discount raise. So I'm going to remove some lines as well because it's extremely messy. So then after this early signs of a sweep, again, early signs of a sweep. When we take out a low right there and we retrace those steps right there, then the early signs of a sweep are, we do not have a fair value gap overlapping right there. We have a fair value gap going higher right there. But if we still have so much resistance going against us, then there is no real argument to be made that we can all of a sudden now continue higher. If we do that, we are trying to call a bottom. So here we still want to wait. We wait. And afterwards, what do we see? We trade back again below that low, indicating right now we are getting comfortable below that low. So if we are getting comfortable below a certain low, then there's a low chance, it's a lower probability that we are now all of a sudden going to sweep it to then still continue higher. So here we eventually run the liquidity and we continue lower as well. So with that being said, let's move on to the next case study. Here we look at RTY, at Russell right here. And we see a 15-minute fair value area right there. And we have a 1-minute fair value area as well right there. Which we can see the 15-minute right there is currently not really getting respected. The 1-minute fair value area is what we are actually continuing higher off of as well. So after that, every 1-minute fair value area right there is what we can actually continue higher off of. Here, we are not necessarily offering fair value, I would argue, at that moment in time. So potentially, longs could be interesting. Now, what do we see after that? We see after that we have 1-minute fair value areas right here holding. If we pay attention, we can see at the most recent 1-minute fair value area that we have a 2-candle rejection actually right there failing, or at least showing signs that it potentially wants to fail right there. It's not following through that 2-candle rejection. So what happens afterwards? Well, same thing. It's all fractal right there. Now we take out those fair value areas and we create new fair value areas actually continuing lower, which we can now continue lower from. So I mentioned that fair value area right there is what we can actually continue lower from. Then right here, we also see on the 15-minute time frame, we are now comfortable below that low. So since we are now comfortable below the low, that indicates to me that we are not sweeping that low. So we are allowing those breakout traders to get out of position, etc., to still be in a position. So we are not comfortable. We are comfortable below the low, and we are not sweeping it. We are not suffocating that position. So right here, I want to go over the chart as well a little bit. And if we take a look at Russell right here, then we see again the same story of the 15-minute time frame where we get comfortable below that low and 1-minute fair value areas right there start to hold to continue lower off of as well. Afterwards, starts to get a little bit messy. That's where I started recording this video as well. I still wanted to use the case study because it's still extremely important and interesting to understand how we deliver from those fair value areas and when we start to disrespect those fair value areas. That's extremely important and interesting, in my opinion, to study as well. So off of those case studies, I would love for you to also practice this. So what I would love for you to do is start tape reading the 1 minute time frame. If you have the time during a London session, so 2 a.m. to 5 a.m. New York local time, or whatever it may be afterwards, if you can start tape reading the 1 minute time frame, that would be perfect. Now, why the 1 minute time frame? Because of course, are we just going to dive into the 1 minute time frame after this as well to look for entries? No, but the 1 minute time frame will give you results quite fast, and it's all fractal. So whatever happens on the 1 minute time frame will also happen on the daily. So if you understand the 1 minute time frame, you are also going to understand eventually the monthly time frame, because it is all fractal. The 1 minute time frame will allow us to practice essentially faster, because we get faster results as well. So start tape reading the 1 minute time frame. See if you can get your bias right by using, again, same concepts, the fair value area right there and the seeking liquidity part. Now, what then exactly is tape reading? Tape reading is just looking at the live market, for example, right here, just looking at the candles printing and just marking up, just what I also did with those case studies. So right here, using a call out to add text. All right, FVA right there, fair value area, which we can continue lower from. What are you expecting off price right there? Those things you can write down. Not demo trading, not back testing, nothing else than just looking at the live chart right there and just studying, making case studies in real time right there on the 1 minute time frame. This can be done on the indices, can also be done on Forex if you do want to. All the same essentially. It's all moving the same as well. And if you want, indices move faster, so you'll likely also get results a little bit faster. But that is how you can do this as well. And that is my advice. Where on Wednesday, we are going to go over fair value gaps, a little bit more in depth. And then on Friday, we are going to go over institutional market structure as well. All right, perfect. Thank you.